And that's about small cap funds now, the risk reward ratio. There are two AMCs who've decided not to take lump sum
fresh money
into small cap funds. I think Nepon is one and Tata AIG is one, the other one, right?
I think
My question to you is that for anybody who's watching the show, the temptation is to buy small cap is real, because small can become medium, medium can become big, big can become large. But purely from a risk reward ratio, do you think one should avoid buying into small cap funds, or it is still worth the bet?
See, I think there are 2 points to that. See, small cap becoming mid cap becoming large cap. This hypothesis was true 10 years back, will be true 10 years from now. So you don't buy or sell stuff on a hypothesis which is a continual variable, right? 10 saal baad bhi I can make the statement that small cap will become mid cap. So that motivation for me to buy today can't be that hypothesis. But if you look at I have data till Jan 31st, pardon me. Of course, there's been outperformance of the small cap post that, is why I'm giving you my disclaimer. The underperformance with Nifty of the Nifty Small Cap 250 index, which is what is most relevant for a mutual fund investor, has been 5% per annum, 5.28 if I remember.
Can you explain that for us? Because it's an important point for our viewers. I mean, there's a frenzy in small cap stocks again and again. So what's your data saying?
January 31st, 5 years back.
Okay.
If you bought Nifty or Nifty Small Cap 250, Nifty Small Cap 250 would have left you poorer for 5 years of investing by 5% an annum.
And you're taking a high risk also, because when you're buying small cap, the volatility tends to be higher.
Absolutely. The beta is definitely higher in the small cap relative to Nifty. But the good news is, when the rear view mirror shows ugly, is when you should muster courage to buy it. So we increased our small cap exposure from an implied 16% to almost about 30% in Jan. Because if the rear view mirror is showing underperformance, can small cap underperform for 10 years? The answer is no. So that's one. And every time in the past this has happened over the last 10 years, that Nifty has outperformed small cap for 5 years. The subsequent 3 years for small cap has been outperforming periods.
Okay, so where is the rear view mirror ugly right now?
Mid caps, it's ugly.
Ugly?
Mid caps.
All-time high. Index all-time high par hai.
No. Rear view mirror, you said. Sorry. The front view mirror is uglier for the 150 stocks.
Okay.
See, from a mutual fund investor, the top 100 is large cap. The subsequent 150 is mid cap. If you look at each individual stock and look at their businesses and look at Bloomberg analyst estimates and try and see what's the forward price targets, of course with some degree of more science, is a 12% target. Nifty is at 15. Small cap index is at 20%. So still there is a lot of relative outperformance on small cap possible, but the mid cap as a space can't be said in the same breath. Most of us generally say mid and small cap in the same sentence, but they're two very, very diverse groups. And a small cap, the largest small cap is now about 17,000 crores. 5 years back it was just 8,200 crores. So small cap as an English word is hiding more than it's saying, because it was small cap, called small cap then, it's called small cap now, but 17,000 crore business is being called small cap. Is something which hit me harder when I was actually doing the math.
So you're saying be wary of mid caps?
Yes, the 150 stocks from a mutual fund investor.
So I'll wrap it up, and I don't get this one wrong. You are of the view that right now, if one is looking at small cap stocks, they've not reached Humpty Dumpty. One can still invest in them. Mid caps have reached Humpty Dumpty, and when it comes to large cap stocks, they're fit and fine.
Yeah, absolutely. One small little point: in small cap, never do index fund investing. Because small cap is all about eliminating those businesses which could be tricky. People generally buy an index, but the fund manager's relevance there is not to manage return, but to manage risk. So that's the only disclaimer I would like to put.
You live and learn so much of data, but so nice to have you. It's your first time.
It's more complicated than we thought it is, right?
Thankfully, that's what gives me a job.
Yeah, exactly.
Good to have you here in our studios, Feroz. We started off by talking about Geo Financial, and then we deviated to a lot of very interesting data points. So it's been interesting to learn your take and your views on the overall market as well.